Today is the 14th of November 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the US markets, the S&P 500 and a very quick look at the Nasdaq. Before we take a look at the markets, and as soon as you have read and made sure that you have understood these disclaimers, I would like to remind you about our new analysis service that we launched only 10 days ago. This is the weekly newsletter, the macro outlook that comes from our new service, Hurst Cycles Notes. Hurst Cycles Notes is a website that provides very comprehensive analysis on many instruments, and the macro outlook is our first weekly newsletter. Here is this morning's newsletter for the macro outlook. You can see it was delivered to my inbox at 10 a.m. European time, so 9 a.m. in the UK, shortly after the markets in London open. Our macro outlook newsletter consists of 9 instruments, which we update the analysis on every week, and we also release intra-week updates if there are changes to the analysis. The importance of the macro outlook is it gives you a bigger picture of all the different markets and how they relate to one another. That is really important. In these market update videos, I only really have time to discuss one instrument because I try to keep them concise. And it's very important to keep an eye on other instruments. We know from the principle of commonality defined by Hurst 50 years ago that all markets move with elements in common. The cycles that are influencing one market are also influencing another market. The weekly newsletter consists of very clear charts. As you can see, you can click on the chart in your email and it comes up full screen if your email program enables that feature. And of course, you can review the macro outlook on the Hurst Cycles Notes site, where you will find a good deal of analysis and information which will help you to stay ahead of the markets, particularly at the moment because there is a lot happening in the markets. Speaking of which, let's take a look at the S&P 500. Now, my most recent update about the S&P 500 discussed the possibility or probability that this trough over here was indeed a 20-week cycle trough. Price has now certainly confirmed that that was a trough of 20-week magnitude. So this is the analysis we've been looking at for some time in the S&P 500 and in other stock markets. The Nasdaq, when we've looked at it, has a very similar analysis. We're going to compare that in a moment. The important aspects of this analysis, of course, are the very prominent trough over here in March of 2020, which is probably a trough of at least 54-month magnitude. There could be some debate, as I often mention in these market update videos, about the exact placement of that trough. Some analysts might suggest that it should be displaced off to the right because of the inevitable fundamental interaction that occurred around the COVID pandemic. Nevertheless, we have an 18-month cycle trough over here in early October of last year, and the big focus for this analysis is the fact that the market is moving down into the next 18-month cycle trough expected early next year. That would mean that the 20-week cycle trough that we have identified over here as having occurred in about the middle of October is the final 20-week cycle, which will bring us down into the 18-month cycle trough. To remind you of what we discussed in the previous market update video about the S&P 500, I like to track the cycle shapes that form in the markets. They are, of course, M shapes in a trough synchronized instrument, and so that is the M shape for the first 40-week cycle following the 18-month cycle in early October of last year, and this has been the 20-week cycle that has elapsed since then in the second 40-week cycle that will eventually bring us down into this 18-month cycle trough expected early next year. We are now experiencing the bounce out of that 20-week cycle. What we are expecting is for this price movement to peak fairly soon and then to move down into the 18-month cycle trough. Why do I say that this price rise should peak fairly soon? Because if this analysis is correct, then of course this 40-week cycle should be more bearish than the previous 40-week cycle. That is the previous 40-week cycle over there, a fairly bearish cycle. And if we are expecting a more bearish cycle, then we would expect early peaks and of course an extended move down. But now I would like to play devil's advocate for a moment. You know that I enjoy questioning different analysis possibilities. And many weeks ago, might even have been months ago, I introduced an analysis that presents a slightly different picture. Let's take a look at that. This is the very long-term picture of that analysis. It is what is called an ICM analysis. ICM stands for Initial Cyclic Model, and the cycle wavelengths that this analysis is based upon are drawn from the initial spectral analysis that is performed at the beginning of every analysis process the Sentient Trader performs. The term Initial Cyclic Model was a term coined by Hurst, and he suggested building an initial cyclic model on the basis of a form of spectral analysis that he performed in his cycles course. The result of this is that you might come up with slightly different cycle wavelengths. They are not very different, but they are a little different. I quite enjoy this analysis because, as you can see from these semicircles at the foot of the chart, each one of these cycle troughs is a good prominent trough in the market. The 9-year cycle troughs you can see there are all good and clear, and the 54-month cycle troughs are fairly clear in this market as well. Here you can see the pandemic trough, or the March 2020 trough, has been phased as a trough of 54 months. Interestingly, this trough over here is not a very clear 54-month cycle trough. That was a difficult period of time for cycle analysts to determine the exact placement of that 54-month cycle trough. But now if we zoom in on this analysis to about the same zoom scale that we were looking at a moment ago, you will immediately see the difference, which is that although the March 2020 trough is still a trough of 54-month magnitude, we have since then experienced two 18-month cycle troughs. The big difference is that this trough over here in the middle of October, according to this analysis, is phased as an 18-month cycle. And so the price movement that we have witnessed recently is, according to this analysis, a bounce out of the 18-month cycle trough as opposed to the bounce out of the last 20-week cycle trough before an 18-month cycle trough forms in the market. As a matter of interest, even this analysis is not particularly bullish because of the fact that we are now in our third 18-month cycle, and of course we have the very bearish pressure of this 9-year cycle bearing downwards and this 54-month cycle bearing downwards, and so the next 18-month cycle is expected to be a bearish one, even according to this analysis. So what's the point of playing devil's advocate when it comes to a Hurst cycles analysis? Is it just confusing? No, not at all. I think it's important to keep an eye on the possibilities and to watch how price action unfolds. Let me explain to you exactly how we are going to do that. Switching back to my preferred analysis, which has the recent trough as only a trough of 20-week magnitude, if we zoom in, we can look in detail at how we are going to monitor the exact magnitude of this cycle trough. The answer is going to be revealed in the shape of the cycles as they play out. In simple terms, these semicircles that I am displaying show the expected price action. Price is going to bounce out of the 20-week cycle trough, and then it is going to drop down into the next 20-week cycle trough, which will also be the 18-month cycle trough expected early next year, as I mentioned. In that 20-week cycle, we will of course have two 80-day cycles that will play out. We are currently in the first of these 80-day cycles. Now, in the other analysis that I showed you, which considers this trough here to possibly be a trough of 18-month magnitude, what is the difference when considering the 20-week cycle and the 80-day cycles? There is actually very little difference, but the shapes of the cycles as they play out will reveal to us which of these is most likely. As I've mentioned, this is the most likely scenario in my opinion, but we don't need to simply rely on my opinion. We can watch very closely as the cycles play out for evidence of bullishness and the persistence of that bullishness. What do I mean by watching the shapes of the cycles? Let's zoom in and look at some more detail. Here we are looking at only the first 32 days that have elapsed since this trough in the middle of October. Let's take a look at the cycle shapes that we are seeing here. According to this analysis, at the moment, the 20-day cycle trough has been positioned over here. In my recent update about the S&P 500, which I think was 2 weeks ago, I stand to be corrected, I think it was on this day over here that I discussed that update, I positioned the 20-day cycle trough tentatively over here. Whether it is over here in the end of September or over here in the first few days, I beg your pardon, not end of September, end of October, or over here in the first few days of November, makes very little difference. The point is, and let's work with the analysis on the chart, the point is that this is a bullish 20-day cycle. We have a move up to a peak over there, or I've positioned the peak over the weekend, which is a little bit strange, so let's rather draw that a little more accurately. The peak price, I think I'm correct in saying, was on that Tuesday. So that's the move up, and then that's the move down into that 20-day cycle. That is a very bullish cycle for two reasons. The first reason is that it is, of course, bringing price up a great deal. The second reason is the fact that the peak occurred so late. So that is a bullish 20-day cycle. I discussed this in the previous market update about the S&P 500, and I discussed the concepts of cycle shapes in most of my videos, so I'm sure you are fairly familiar with them. Now let's take a look at the 40-day cycle trough. Here is the nest of lows for the 40-day cycle trough, but you will notice this circle for the 40-day cycle is sitting directly under this bar over here, which was on Thursday. Some analysts might consider that this trough over here was in fact the trough of the 40-day cycle, and I would probably be one of them. I would position the 40-day cycle trough at that position over there and move the 20-day cycle trough a little bit earlier. The important thing is that whether the 40-day cycle trough has occurred over there or whether it does still lie ahead of us, it seems very likely that this is going to turn out to be a bullish shaped cycle. If it has already occurred, then the shape of that cycle is also a bullish cycle, as you can see, with a late peak and a strong price movement upwards. If the 40-day cycle still lies ahead of us, then of course we have an even later peak, and it seems unlikely that the markets are going to crash all the way down and bring us down to a lower price. It's still possible, of course, but it seems unlikely. And so we have a 40-day cycle which is bullish. By constantly watching the cycle shapes that are formed in the shorter cycles, we are going to be able to monitor the state of the bullishness of this market. If the trough that formed in the middle of October was only a 20-week cycle trough, then of course we are going to see some of the bullishness beginning to dissipate as price comes down into the 80-day cycle trough. I've actually moved this chart. There we go. There's the 80-day cycle trough. Here is the nest of lows for the 80-day cycle trough, expected in about the middle of December. And so we're going to be watching the shorter cycles, the 20-day, 10-day, and the 5-day, monitoring those cycles for evidence of bullishness or lack of bullishness. As we monitor the cycle shapes that form in the markets, we will of course be referring to our cycle tools. The FLD, as you know, is my favorite tool. Here is the sequence of interactions between price and the FLD, following the formation of a trough of at least 80-day magnitude. Price crossed above the 20-day FLD. That's an A category interaction. It achieved its target. I can't remember exactly where that target was. It was somewhere over here. It achieved that target at about the time that the 20-day cycle trough formed in the markets, which in my opinion was about over here. Price should have come down to find support at the level of the 20-day FLD. The fact that it was above the level of the 20-day FLD at that time was an indication of continued bullishness in the market, as discussed in the previous market update video. Price then crossed down below the 20-day FLD and didn't quite achieve its target, which is again an indication of persistent bullishness in the market. Price has crossed up above the 20-day FLD, and it did in fact just on Friday reach the target for that move. What is expected next in terms of the 20-day FLD, we are looking at price coming down below the 20-day FLD on its way down to the 80-day cycle trough. As price does that, we will be able to generate a target for that cycle trough and be able to monitor the bullishness or lack of bullishness as price moves down towards that cycle trough. The 40-day cycle FLD is also providing us with some useful information over here. That is this blue colored line. Again, we have the same sequence of interactions. We had a rather complicated interaction with price crossing above the FLD and then below the FLD and then above it again and then finally breaking up above it over here, which generates a rather complex target. But there are ways of calculating complex targets when you have multiple price crosses of the FLD. That target was at a level about over here, which was of course reached. And then at about the time that the 40-day cycle trough is due to form in the markets, and there's that nest of lows of the 40-day cycle trough, we expect price to find support at the level of the FLD. So, as you can imagine, last week I was watching with great interest to see whether the 40-day cycle FLD provided support to the market. There was a little bit of a wobble on Wednesday as price came down below the FLD, but it bounced back up again on Thursday, and indeed the 40-day FLD has provided approximate support, raising the chances, in my opinion, that the 40-day cycle trough has indeed formed in this market. The 40-day cycle FLD will give us another way of calculating a target for the 80-day cycle trough, because when price does cross down below the 40-day cycle FLD, it will generate a target to the downside, which will be an interesting target to watch for the 80-day cycle trough forming in the market. I promised that we would take a quick look at the Nasdaq because the Nasdaq has a very similar analysis to the S&P 500, but there are some interesting differences. In terms of what has happened recently, I believe there is basically no difference because of the fact that a 20-week cycle trough has formed in the Nasdaq. The interesting difference with the Nasdaq is the fact that the December 2018 trough was in fact lower than the March of 2020 trough. And so a normal phasing analysis, I say a normal phasing analysis, an analysis that is not influenced too much by the analyst, generally finds the 54-month cycle trough as having occurred in December of 2018. That means that the pandemic trough of March 2020, or possibly the trough a little after that, would be phased as the first 18-month cycle trough. The next 18-month cycle trough occurs as we have it in the S&P 500 at the beginning of October last year. But the big difference here is that we have then experienced two 18-month cycles in the current 54-month cycle. That means that we are now in the third and final 18-month cycle of this 54-month cycle, and the trough that is expected next year is not only of 18-month magnitude, but possibly of 54-month magnitude. If we zoom in on this analysis, you can see there is the 20-week cycle trough that formed in the middle of October, and you can see the cycle shapes that we have been discussing in the S&P 500, not quite so bullish for that first 20-day cycle, and we have had some bullishness, of course, occurring recently in the Nasdaq. But we will monitor the unfolding cycle shapes in the Nasdaq with the same degree of interest as in the S&P 500 to determine where we can expect the 80-day cycle trough that you can see should form in about the middle of December, and also where we can expect this very big cycle trough that is expected early next year. Is it possible that this trough that formed in the middle of October was a very high magnitude trough in the Nasdaq, as discussed in my devil's advocate suggestion in the S&P 500? It is just possible, but much less likely in my opinion. And the reason for that is that if we measure the number of days that have elapsed since the 54-month cycle trough phased in December 2018, you can see that only 46.6 months have elapsed. The average length of a 54-month cycle is indeed 54 months, and so we are still expecting several months to play out before the next 54-month cycle trough is expected. But as is the case in the S&P 500, we will be watching the shorter cycles very closely to see exactly how the market is behaving and to see how much bullishness there is as price bounces out of this 20-week cycle trough. I do hope that you found this market update useful and interesting. Make sure that you head over to the Hurst Cycles Notes site. I will put a link in the description below this video to make sure that you stay up to date with a Hurst Cycles analysis of what's happening in the markets. If you have any questions, you are also very welcome to join us on our Hurst Cycles Discord server or post a comment below this video. I look forward to hearing from you.